Well, hello. Welcome to the first ACT webinar in the Middle East. Given some of the distances involved in getting together in person, I hope this will prove to be a great way of having a virtual meeting and sharing knowledge without the associated costs of travelling. I understand we have over 200 people who've registered for this event today, so that's a really good result already. I am Andrew Folks. I am the head of Treasury and Risk at Emirates Aluminium in Abu Dhabi, where we're building one of the world's largest aluminium smelters. I've been there for 4 years, and before that, I was Group Treasurer at Linpack, based in the UK, and before that, I headed the European Treasury Consulting practice at KPMG. So I've seen a lot of cash forecasting in my time. I'll be your virtual chairman for today's webinar. Before we start, I'd like to just mention a word about our sponsors, OpenLink. We're very grateful to them for sponsoring today's event. Founded in 1992, OpenLink's a global leader in transaction lifecycle management solutions for corporations, banks, and energy companies. These include treasury management, portfolio management, trading, risk management, and operations processing systems. Their headquarters are in New York. Their revenues are over $300 million a year. They have 1,300 employees in 12 offices around the world, serving over 500 clients. And one of those offices is here in Dubai. The OpenLink Treasury Management Solution, which is what we're interested in today, integrates all aspects of treasury management, from cash and liquidity management and funding and investments to firm-wide hedging, risk management, financial reporting, and hedge accounting. It's delivered as a cost-effective solution, either on demand or as client-managed software. So thanks again, OpenLink. So what are we talking about today? Well, the agenda is about the vital topic of cash forecasting, or more specifically, how to drive business value through integrated cash forecasting. We're going to look at this today with the help of 2 presentations. The first is going to be from Erwin Medford and Zahid Khan of PwC Middle East. PwC are going to cover the first 2 bullets there on the slide. The first, the importance of cash flow forecasting and common forecasting pains, which I'm sure many of you will have experienced like me. The second part of their presentation is to look at integrated cash flow forecasting using driver-based methodologies. In the second presentation, we're going to hear from OpenLink's Sales Director, Richard Childs. He's going to tell us about the role of technology in improving the efficiency and accuracy of cash flow forecasts. So how do we actually do it? I look forward to the presentations, but just before we start, I'd like to mention a few words about polling and questions throughout the webinar. You all registered and answered a question when you registered about what is the thing that interests you most in this webinar today. And you can see on the screen there what it is you said. 72% of you said improving efficiency and accuracy. Well, I guess I might have expected that. Only 11% of you said you were interested in driver-based methodologies. But maybe we're going to hear a little bit more about those today, and you can see whether that provides you a little bit more insight into cash forecasting. This is the first question that you've asked. In fact, you can now, going forward, ask questions all the way through the webinar. Your questions will be collected. They'll be reviewed by our webmaster, Michelle Price. She'll select the ones that she thinks are most interesting to the group as a whole, and she will pass those on to us here. And we will ask those questions of the presenters at the end of the presentation. Also, if you look on the top right of your screen now, you should see a box which says questions. If you click on that box, then you type in your email address and you type in the question and press send, then that question will go through into the pile with the others. We're also going to be asking some questions as we go through, polling questions, where we ask you online to vote on the answer to a particular question. There'll be 3 of those, and we're going to start in a minute with the first question before we start with the presentations. So if I just click on to the next slide. You can see there now in front of you how you participate in those 3 polling questions. You see the little icon next to the presenters, the word presenters on the screen. If you click on that little icon, that will allow you to vote on the answer, one of these 4 answers to this question. This first question is, what would you say is your greatest challenge in building an accurate cash flow forecast? You can only choose one of these, so think carefully. Is it uncertainty about the timing of receipts? Is it the poor quality of underlying data received from other departments? Is it lack of systems to aid with cash forecasting? Or is it the volatile business environment? So please click away now and choose your answer to that question, and we'll present the results of these at the end of the webinar. I think you've probably heard enough from me, so I'd like now to move on to introduce you to our two first speakers from PwC, Erwin Medford and Zahid Khan. Erwin Medford is a senior manager in PwC's advisory function. He's a fellow of the ACCA and holds ACT certificates in international treasury management and financial mathematics. He's got 12 years corporate treasury experience, both as a consultant and in industry. And I know he's worked in industry because for the last couple of years, he worked with me at Emirates Aluminium, developing our treasury function. Zahid Khan is also a senior manager at PwC. He's a certified public accountant with over 15 years experience working with the big four accounting firms in the USA. He's got deep technical knowledge in implementation of enterprise performance management systems across different platforms and industries. So Erwin and Zahid are now going to talk to you about driving business value through effective cash forecasting.
Okay, thank you, Andrew, for that introduction. I will now take you through the importance of cash flow forecasting. And what I will do first is I will give you an overview of common forecasting techniques. I'll follow this up with the pros and cons of these techniques. And then I'll conclude with a discussion on the challenges of forecasting pains faced by organizations when producing a cash flow forecast. So let's take a look at the benefits, which you can see on screen. If a cash flow forecast is produced with a reasonable degree of accuracy, the treasurer, the cash manager, or any user of the cash flow forecast, they can look ahead and make an informed business decision. And what do I mean by that? Let's take an example where you have a group structure or even a joint venture. And let's say a subsidiary within that group has a cash deficit and another one has a surplus. Then, provided that the regulations allow, it may actually be more cost-effective to raise an intercompany loan rather than seeking external financing. And of course, we all know about emergency payments and having to hold large idle cash balances for these so-called unexpected events. This often results in low interest earnings, or if any at all, or you may have to dip into your overdraft, and overdraft financing can be quite expensive. All of this, of course, you can avoid by using a reliable forecast, which is what we'll be talking to you about. These are what I call the common or more obvious benefits of cash flow forecasting, but the benefits of cash flow forecasting, they actually go beyond this. And if we actually examine the cash flow forecast, and particularly where we're doing variance analysis, it actually is quite a useful and handy tool which would show you trends in the market. When you see a variance, it can actually mean that there's a fundamental problem in the business. And what we are seeing here is that Treasury, in this instance, can take the lead. And this is where we get the integrated benefit of cash flow forecasting. They can take the lead and alert whether it's sales and marketing, whether it's production, of these permanent changes. What I'd like to do now is take you through some of the techniques for forecasting. So we've heard the benefits. Let's look at the techniques. I've got 3 techniques outlined. It's not a comprehensive list by any means, but these are the more common techniques. I'll take you quickly through each in turn. So the direct method, this is one that's most commonly used by most of us. It tends to be used in a sort of a short-term period. When I say short-term, I mean up to 1 month. In more sophisticated organizations, perhaps up to 3 months using the direct method. What it does, it's basically you look at your inflows, you net them off against your outflows, you add these to the opening cash position, and you come up with a closing cash position. Very straightforward, basic method, which I guess most of you can relate to. Indirect method, this is the method where you're using your financial statements to arrive at your cash balance as a balancing figure. So what happens typically is you look at your income statement, some people call it the profit and loss, and make some adjustments. For for timing differences, or you would make adjustments for things like depreciation, which don't have a cash flow impact. And then that would result in your cash flow forecast. So that's the indirect method. Statistical methods, they are typical things like regression analysis, distribution, moving average. And with statistical methods, yes, you can use them on their own, but what we have observed is they tend to supplement the other two methods. Whichever method you're using, let's say you're quite in your infancy stage of developing your cash flow forecasting model, I've outlined 10 steps which I believe can be quite useful. Won't go through them in detail, but it's there for your information. Moving on, we've examined the different techniques. What I would like to discuss is which one is the best. Well, the answer is you've got pros and cons of each. The direct method, we heard that it's simple, easy to understand, high degree of accuracy in the short term, and you can prepare it at quite a granular level. The downside of it can be difficult to reconcile to your financial plans because you're using a bottom-up approach trying to compare it to a top-down approach. Indirect method, good for longer-term forecasting. You should get one version of the truth if it's aligned to your financial plans. But you are relying on accounting cycles, and it can be challenging to perform variance analysis and get to the root cause of these variances. Statistical methods, they are quite handy for complex organizations where you've got a large group company with many subsidiaries across many geographies. And the timeliness of the information coming back to, let's say, the central treasury is not always that great. So what they may need to do is use some sort of statistical technique, let's say trend analysis or even regression analysis, to arrive at the forecast. The challenge with this method is that you do need high-quality historic data source. And if you've got any abnormal events in these historic events, it may skew the forecast. And there is sometimes a general perception that this can be quite a complex technique. So we've seen the forecasting techniques, we've seen the pros and cons of them. And because we don't have a single perfect technique, obviously organizations would have some forecasting challenges, or what we call forecasting pains. What I've done is we're going to look at these forecasting challenges in three broad groups: the people aspect, the process aspect, and of course the technology aspect. From the people perspective, what you find is sometimes people look at this as a time-consuming activity with very little benefit for them. In particular, where you've got performance measures, and these performance measures may be on EBITDA, so there's no impact to the person whose performance is being measured if they submit a bad forecast and it results in higher interest costs or even lower investment rates. So they don't feel the impact, very low incentives for them. If we look at, say, process, one of the common problems we see there is the whole question of trying to predict your customer behavior. How many people can actually say, yes, I can tell with certainty when my customers will pay me? Yeah? That is one of the key challenges. With technology, if we move on to technology, there's high reliance on Excel spreadsheets still, and there are inherent risks in Excel. You may have multiple data sources, and quite often there's low confidence in the system capabilities, and this results in underutilization. What I'd like to do now is hand over to my colleague, Zahid. And what Zahid will do is introduce you to a methodology which hopefully can address most of these pains. And later on, you will hear from Richard, who will talk about the technology. Over to you, Zahid.
Thank you, Irvin, and good afternoon. I would like to show you some slides on detail about leading practices in integrated planning and how it can help minimize some of the pain points that Irvin just mentioned in the last slide. I should note that the details we are going to show you today are based on experiences we've had with a variety of complex clients across industry. We recently completed these projects for large multinational companies, and what we noticed was a clear pattern of leading practices versus lagging. The leading practice in planning is integrated planning. You hear everyone talking about integrated plans, linking their 3 to 5 year plan with the annual plan to the forecasting, as I'm showing it on the slide. So you've got the strategy plan tied to your annual planning, to your reporting, and then to forecasting. But more often we see clients wanting to have that integrated process, but not able to achieve. What we've seen at the leading companies, that the foundation to have the integrated process is to what I'm showing in the middle, the enablers. That it is a driver-based planning, and that there is a change management because you are fundamentally changing the way you're running your business, and the planning process is changing. And lastly, that it is a unified technology, because as we all know, that you can build the best processes and have the best people, but if you don't have it supported by an integrated technology, you're not going to be able to sustain such kind of a change. So what you see on the left are the strategic objectives. So what we do is, first thing we try to do is to quantify what are those strategic objectives for a corporation. So what you see on the second column are the key metrics. And typically we see about 4 to 8 key metrics, like revenue, operating margin, your cash flow, and your employee engagement. So typically there are about 4 to 8 metrics defined differently by organization, by industries. And in the last column are the key drivers. So for example, what actually drives those key metrics? And these are just a list of drivers. And again, these will be different by industries and the complexity of a business. In this slide, we have an illustrative example of a net cash flow tree for a consumer product company. So these are just a straw man to show how a net cash flow tree would be developed. After getting a list of the drivers, the next exercise is to stack them in a hierarchical manner through mathematical formulas and building the correlations between each drivers and doing a regression analysis to prioritize these drivers, whether they lie between the third level, the fourth level. It all depends on the sensitivity analysis of each driver to the net cash flow. This is where most of the heavy lifting comes, defining the relationships of one driver to another driver. In many companies, we see cash flow forecasting is an aftermath exercise. Through driver-based planning approach, you can see how cash flow forecasting becomes part of the planning process. The benefit you get out of driver tree is that all stakeholders of a company are involved in the planning process. So it is no longer a finance exercise or an operational exercise, but you are now able to involve Treasury as part of the planning process. Each driver has an owner and performances are tied to them. Through driver tree, you're able to see the impact of an operational decision like promotional spend and how it will impact the sales, or how customer credit rating will impact your DSO and subsequently impact the cash receipt. Another benefit of driver-based planning is that there are fewer elements that you are planning for. For example, you have the drivers that I've highlighted in orange are the key drivers that you will be inputting. The rest of the drivers, for example, sales volume, is just a calculation. So by this, you're actually able to reduce the time you spend on planning, and you're able to continue to develop your forecast in a shorter amount of time. One thing to note here is that there are dotted lines for each of the plans. So for annual planning, the forecasting, and the 3-year plan. This is how you're able to accomplish an integrated planning process. So your 3 to 5 year plan is integrated with your forecasting to your annual planning. This is a crucial step that ensures the planning process is integrated. The next slide shows that you can use the driver-based planning to give the kind of decision-making and the insight that you're looking for from your variance analysis. The example on the left, where the revenue targets were missed. When this happens, typically you bring out the beating stick. The treasury manager will be blamed for higher interest expense because he may have to borrow more due to the shortage of cash receipts from sales. But as we dive deeper, we see the root cause of the variance was due to the fact that units sold were less than the target. Now, why were the units sold target less? We dive deeper and that the business manager was able to increase the market share while maintaining the price. The problem is that the market sizing people got their sizing wrong. So the strategic question here is that is it worth for us to be in this market because it is so small, but operationally we have a strong performer? On the example on the right, where the revenue targets were exceeded, now in this example, when the targets are exceeded, someone is rewarded. Subsequently, the treasury manager may also be rewarded as the interest income would have been more than the planned due to cash receipt exceeding the planned amount. But when you dive deep into the driver tree, you see we have a poor price discipline. We have a differential of 4, which is due to heavy discounting the business manager gave. The worst is when you look at the market share drivers. They only achieved 2/3 of what was targeted, and the market size was 3 times larger than the manager predicted. So again, the strategic question is, this is a much bigger market than we thought. Maybe we got to invest more, but also an operational question that we might have an effective manager managing this business. So this is a quick example of how a driver-based planning can help in the analyzing the root cause of variances. In the last slide, I just wanted to quickly review the typical architecture that we see when we're implementing a driver-based planning. The key to implementing a successful integrated planning process is the integration of technology to support the data that is needed for driver-based planning. In driver-based planning, as you see, that it will consist of both operational and financial drivers, and a guiding principle would have to be a single source of the data. To do these type of changes in a real transformation, it does take a serious amount of work to go through this process. I've walked you through a fairly simple example today, but of course, when you're dealing with large, complex organizations with lots of products, lots of geographies, lots of business units, it does get very complex, but in the end, you don't only get an integrated planning process, but a tool to help in better decision making. Thank you, and I will be happy to take any questions related to driver-based approach in our Q&A session. Now I will hand it over to Andrew.
Zahid, thank you very much. That was very interesting, and I certainly agree that it's important to embed cash forecasting into the routine planning process. So much better way of tackling it. You mentioned questions, and I hope if some of you have questions for Zahid or Owen, that you'll click on your question button now and send them in. We will deal with those questions at the end. I can actually tell you, I can answer one of the questions now. Actually, I see a question has come in, and that question from somebody was, has the webinar started? Well, the answer to that question is yes, it has. Now, I said that there would be 3 polling questions that we would ask throughout the webinar. This is the second one now. So please look again to voting on this question number 2. When you look toward continuous improvement in your cash forecasting, do you consider a regular variance analysis in your cash flow procedure to determine how accurate the model was? Do you consider evaluating the impact of any unusual or unexpected events that occurred during the time period? Do you look at analysing variances between forecast and actual to determine if modifications are needed in your process? Or do you look at determining how structural changes may impact historical trends? So take a moment just to think about that and vote. You can click on the little histogram symbol next to the word presenters on your screen and vote on that. Now, we move on to our second presentation, and this one is from Richard Childs, the Sales Director of OpenLink. Richard is going to tell us about the role of technology in improving efficiency and accuracy of cash flow forecasts. As Sales Director of OpenLink, Richard looks after both banks and corporates and has got over 10 years' experience working in some of the largest corporations. His credentials include roles in front and back office, as well as designing, selecting and implementing a variety of treasury and risk management systems. So excellently qualified to tell us about this subject. Over to you, please, Richard.
Many thanks for the introduction, Andrew. I'm going to discuss basically the role of technology in cash flow forecasting and how it can be used to meet some of the challenges the corporates and the banks currently face. First of all, thanks to Owen and Zahid for their lead-in presentations. I'm going to touch on some of the points both of those have made within this particular discussion. So, first of all, if we talk about cash flow forecasting, what are the objectives typically of a cash flow forecast? And I'm talking here from a technology standpoint. So what users want are timeliness. They need to see data. They need to see their cash flows in real time or very near real time. They need accuracy and reliability. Typically, a lot of systems provide a cash flow number and you have no idea where it has come from. And what we're going to look at is aim to address the accuracy and reliability element and where that problem comes from. Next is flexibility, the ability to look at data in different ways, the ability to select just certain parts of the cash forecast to analyze and perform trend analysis on potentially. Next, granularity. So how can we drill down into the underlying drivers that are causing the most movements within the cash flow forecast? And then finally, automation. Automation is a key point. As Owen had mentioned, some of the biggest pains within the forecasting world are the reliance on complex spreadsheets, multiple data sources, lack of reliability, and the time taken to complete these. With automation from all of the systems, as Zahid had mentioned, within the enterprise forecasting model, we can overcome many of those pains to produce really good, accurate, and reliable data in a timely manner. So in terms of the uses of the forecast, yet again, Owen had mentioned some of these in terms of common benefits, but within the Treasury world, we look at cash management. Clearly, short-term cash management and cash forecasts go hand in hand. Knowing how much money you have today, how long you can invest it for, or when you need to borrow and how long you need to borrow for are key to organizations in terms of managing their cash and liquidity. Next are managing your exposures, both to FX, but also to interest rates and commodity risks. If you're planning your forecasting accurately, you can realize the flows from all of those different transaction types and hedge accordingly. So you can look at your FX, you can look at your commodity flows and see how they translate into cash movements at future dates, either on a fully known basis for fixed instruments, or if they're floating instruments, what are the projected cash flows associated with, for instance, some commodity swaps that are going to fix in a month's time. And you can use that data within your hedging and your cash planning. Next, we look at another point that Owen has mentioned is debt and funding. Is it better to borrow on an intercompany basis or to source funding from external sources? Having the data available in a flexible manner allows you to do that analysis and determine where you should look at borrowing or investing your cash. So moving on to the next slide, and what I've done here is I've really tried to typify the types of forecasting systems in place against the 5 main drivers that are considered from a technology standpoint as being the biggest pains people face, and they are timeliness, accuracy, reliability, flexibility, granularity of the information, and the level of integration/automation. Now, at the start, many organizations out there do very little or very manual forecasting processes, and as you can see from the table, you get very little in terms of timeliness, accuracy, reliability, flexibility, etc. with this type of approach. If you look at specific forecasting systems, and they could be systems in Excel, Access, or specific vendor-provided solutions, you increase the benefits, but you're still missing out on things like timeliness and accuracy. And that is mainly because you don't really have integration. In the more advanced solutions, you also get more accuracy, you get more flexibility and granularity, but you're still missing that integration. And because you don't have integration, timeliness is also an issue. Things are having to be done manually. And then finally, in that bottom category, you have all of the boxes ticked, basically. Because you have integration, you get timeliness, accuracy and reliability, flexibility and granularity of data. And that's really what we're looking to achieve within our treasury management solutions. So moving forward, what should a forecasting solution have? So basically, Zahid mentions driver-based forecasting. So the users should be able to define the drivers themselves within a solution. They should not be prescriptive. The users need sophisticated reporting. They need to be able to define reports and slice and dice the data at will. They need to integrate the treasury cash flows, i.e. the cash flows arising from treasury transactions such as your FX, your interest rate flows, into the forecast process. Clearly, the forecast is one of the key, the treasury forecast is one of the key inputs into the cash flows. Next, you should integrate the forecast into your cash position worksheet so that you know what your likely outflows are going to be either today, but also tomorrow, next week, or the week after. You need to enforce controls and provide auditability, and they go towards reinforcing the accuracy and reliability of the forecast. For you to have confidence in your forecast, you need to know it's accurate, the numbers are correct, it hasn't been updated, it hasn't been changed by someone, and you can rely on those numbers. And then you need to allow for integration of that forecast into other enterprise-wide systems, for instance, business planning systems, where you might need those inputs for your performance measurements, as Zahid mentioned. So the Treasury is both a source and a recipient of that information, and you need to allow the integration of that. So in terms of integration, what we at OpenLink aim to do is provide a completely open architecture to allow the various different inputs into a cash flow forecast to be managed and either imported or exported or integrated into other systems. And clearly one of the main points are the transactions within Treasury, any information from your ERP systems, maybe accounts payables, receivables, etc., any customer relationship information that will impact your cash flow forecast. Supply chain data, such as volumes of commodities, sales, etc., etc. And then finally, manual overrides. There might be factors within your forecasting that need to be overridden because you know from a business perspective they're not going to happen at a certain point or they're going to change in volume. And what we aim to do with our architecture is provide for real-time integration of all of these data sources into the forecast. We provide fault tolerance and scalability. Maybe today you only have treasury transactions and ERP input, but tomorrow you might want to have your supply chain and your customer relationship module interfacing in as well. And we allow for that integration and the scalability of that integration within the solution. So moving on, what do we provide as a forecasting framework? We've looked at driver-based methods, indirect, direct, and statistical methods. At OpenLink, we embrace all those types of those solutions. The treasury transactions in the system, the known and the projected cash flows for your fixed and floating transactions, the cash can be predicted. You can enter into the system what-if transactions. So what if I were to issue debt next month? What would be the cash flows associated with that, and how would that impact my cash position, my cash flow forecast over either the short term or the long term? You can look at driver-based forecasts or subsidiary input forecasts and how that impacts your positions. And then you can also input manual adjustments, for example. The solution allows all of those to coexist in a single seamless integrated solution, giving the users the most benefit and the most up-to-date and real-time information they need for their business decisions. And moving on to how Zahid was explaining the driver-based architecture, as I mentioned just now, the Treasury system in the bottom right-hand corner is both an input and a recipient of a driver-based methodology. Clearly, the Treasury is at the cutting edge or the front end of the cash flow forecast within an organization. They not only are key in providing information into that plan, but they're also key in using that information for driving business decisions in terms of cash and liquidity management, but also debt and capital market type transactions. So this really focuses on we send the information in and we can get the information back out and use that within our cash and treasury management system. In terms of reporting, we discussed very early on, users need to be able to slice and dice data in various ways. They have different requirements for cash forecasts. It's not just to see one cash number. So the data must be in real time. You must be able to do filtering, pivoting, etc., and look at the data in various ways. You must be able to drill down on the data and see exactly what constitutes the number you're looking at. You should be able to integrate all of the treasury flows from your deals into the forecast, but likewise integrate all of the forecast flows into your cash position worksheets for managing your liquidity and cash management on a day-to-day basis. You should provide user-defined time horizons and groupings. Some people in the Treasury might want to look at cash on a daily basis or an intraday basis. Others might want to look at it in maybe 1 week, 1 month horizons. And you must allow for the same data to be sliced and diced in different ways to provide confidence that everyone is looking at the same information. In terms of controls and auditability, one of the key things is to be able to provide clear data and clear knowledge to the users that the data is what it is, and this is how it has evolved over time. Within our solution, we provide visual views of that data highlighted to show what the differences are and when they were changed and by who. For example, from transactions, so deals, all the way to business units and counterparties. Maybe you're adding new business units into the system or changing currencies on business units. That has an impact on forecasts, and we need to know when that happens. Down to maybe bank accounts, creating new bank accounts, renaming bank accounts. All of this is very visual and very, very clear to the users. More importantly is the ability for users to define their own processes in a visual manner within the solution. OpenLink provides visual workflow tools to allow users to drag and drop and build their own business processes. So businesses can enforce what makes sense to them rather than what is prescribed by the solution that they're implementing. And as you can see on the screen, there's a very simple example here for if a user creates a business unit, how do we want to run the authorization for that business unit before it can be used in either forecasting or dealing, for instance, if it's a bank or an internal business unit. Okay, and what you can see here is a dashboard view of that process showing that there are 18 business units waiting for authorization after an email has been sent to the various authorizers. So you can see where the bottlenecks are in the process, and you can very easily demonstrate to your auditors that you have various authorization and segregation of duties in place. So with that, I'm going to hand back to Andrew for the final polling question.
Okay, well, thank you very much indeed, Richard. That helps me to put into focus how a system can support cash forecasting in the way that Erwin and Zahid have described earlier on. Now, very appropriately following on from that presentation, we come to the third polling question. But before I ask it, please don't be backward in coming forward with your questions for the presenters. They're here looking forward to having a tough or challenging question that you might put to them. So I see there are some more questions coming in now. Please don't forget to click that question button and send in your questions now. While you're doing that, polling question number 3. This is the third and last question in the poll, and it's a very straightforward one. Which method do you use for cash forecasting? There are 4 options to choose from: spreadsheet, a specialist cash forecasting system, an integrated treasury management system, or other. I guess if you don't have one, you should tick the other box. So please now look at those and vote on which of those forecasting methods that you use. While you're doing that, we can, I hope, move on to look at the results of the first polling question that we asked at the beginning of the presentation. So, Katie, do we have that? We do. Okay, we asked what you would say is your greatest challenge in building an accurate cash flow forecast. And interestingly enough, we like to blame it on the other departments. 37% of you say it's other people not providing you decent data. I think that that's probably an experience that everybody has, although maybe it's incumbent upon us as treasurers to go out there and talk to people, educate them, persuade them to give us the level of data that we need and is appropriate to manage our cash forecast. Certainly uncertainty around the timing of receipts, which is the second past the post, is a notoriously difficult thing to forecast in cash forecasting because it's something over which you as a company very rarely have direct control. You can influence it, but you can't completely control it like you can with your payments. I see that lack of systems scores only a fifth of you say that that's a problem. I don't know, Erwin, have you got anything to comment on that?
I guess to some extent I'm a little bit surprised that timing of receipts wasn't at the top. When we look at poor underlying quality of data, I guess that's the whole reason behind this webinar today, is to allow people the opportunity to see that if you integrate your process, become part of the planning / forecasting, then with this integrated approach, it should inevitably lead to better quality data. And in terms of the lack of systems to aid with the cash flow forecasting coming, you're saying 1/5 of it, we see technology as a key enabler within that process.
Yes, I think I would tend to agree with you. And Richard, what is your view on that?
Yeah, I would actually agree that whilst there are 4 questions here, I believe all 4 of them can certainly in part be overcome from the use of technology. Poor quality of underlying data, if you automate and integrate into the ERPs and the APs and AR systems, you're going to get better quality data, or certainly to the quality they have in those. Lack of systems, clearly. Uncertainty around timing of receipts, yet again, if you interface into the systems where those receipts are managed, you're going to get more up-to-date information. So for me, the top 3 very clearly point towards systems and technology. The bottom one, technology and systems, can help greatly in predicting the future by putting in, scenarios, etc., etc.
I guess that reflects what you've said in your presentation, but I see Zahid has got his hand up as well. Zahid.
Yes, and so this is where the driver-based planning can also help assist in the, for example, on the timing of the receipt. You can include drivers such as your customer credit rating to include into the DSO calculation, and that this would help out in the actual calculation of your time, improve the timing of your receipt. On the other one, the underlying the data, one of the methodologies that we do follow when we're doing a driver-based planning is to have a governance model where you are actually, as I said before, each of the drivers you are assigning an owner. So there is an ownership attached to each of the drivers, and it is their responsibility to make sure that the data is accurate. So a driver-based planning, as you follow the methodology, you can actually improve on the timing of the receipts and the underlying data.
Thank you very much, Zahid. Well, I think we can also now move on and look at the answers to the second polling question. Okay, the second polling question was, when you look towards continuous improvement, do you consider regular variance analysis, evaluating the impact of unusual events, analysing variances between forecast and actual, and determining how structural changes may impact historical trends? And we have got a resounding 64% who think that the best way of achieving continuous improvement is analysing variances between forecast and actual outcomes to determine if modifications are needed in your process. I personally think that's an extremely important way of obtaining improvement, because if you don't look back at what you've got in the way of a forecast and compare it to the real thing, you have no way of measuring whether your forecast is any good. I think Zahid is probably going to endorse that.
Sure, and this is one of the methodology, part of the methodology on the driver-based planning is that once you have drawn up the driver tree, it doesn't end there. Right? It is a continuous improvement as you are maturing, as you are finding out more internal and external drivers of the cash flow forecasting. You're continuously trying to improve your process and improve your tree. And one of the clients, what we've done is we're continuously actually doing a correlation, trying to find the sensitivity. For example, for each of the driver, how does it correlate with your cash flow forecasting? And this is where it is when I was showing you in the driver tree the levels, and this is where you will actually change the level. So a driver that might not be, at one point was sensitive enough for the cash flow forecasting might not be in the future. So you would actually change. So it is a continuous process.
Okay, well, I think that's absolutely right. And I suppose that in order to do this, to compare the actuals with the forecast, you need good system support. So, Richard, can systems provide this support?
Absolutely, and with the integration, the more you integrate into the systems that hold that information, the better your reporting capability is going to become. It's not just good enough to send through forecasts of what the, for instance, accounts payables, receivables are going to be in the next week, month, etc. But as those accounts receivables and payables happen, you need to import that data into the system as well, or have visibility of that data from maybe the bank statements, etc., so that you can do that analysis. And I really think that, variance analysis and looking at differences between what was forecast and actual is key. But what's also very important is what was forecast last week to what is forecast this week. Why is there a difference? That could be not necessarily down to actuals being realised, but to forecast changing. And that is also key in Treasury decision making.
Okay, so thank you very much, Richard. Well, that deals with the second of our three polling questions. Now, we're not going to get the results of the third polling question for a while. It takes a minute to collate that. So what we can do now is we can move on to some of the questions that have been coming in from you as members of the audience, and I see there are some more questions coming in now. Just before we move on to those, I'd like to ask a couple of questions of the panel that I think will be of interest to everybody. And the first one is to ask, what is the most successful or interesting? The thing is, it's all very well to talk about this, but is it possible to actually do it? Can you implement it? And so my question really is, what is the most successful or interesting example of cash forecasting that you've actually seen implemented? And Erwin, I think you have an example.
Yep. Talking from actual practical experience here, having worked with a large food company, and I was involved in what was called a business excellence project. And one of the objectives of that project was to improve the forecasting, cash flow forecasting, financial planning. And I think what was key in that project and why it started on the right foot was this was actually sponsored by the CEO, as high as you can get. The CEO said to a very large audience that this is my legacy. And in so saying, he immediately got buy-in from his direct reports. And with that level of sponsorship, you find it a lot easier to overcome this sort of internal bickering and even internal politics. And I think that is one of the key aspects to success. Yes, you can have your technology, yes, you can have your process, but unless you put that people dimension in, which clearly was factored in this case, and if you ask me what was one of the key success factors, I would say was that level of commitment from top management. Okay,
I think that's hugely important. So, Richard, do you have any examples or comments on that?
No, I just completely agree. It's people are going to be the biggest deciding factor in whether a forecasting process is successful or not, and you can't underestimate the amount of work that is required to get a good forecasting process in place, and quite often that amount of work is required by a fairly small team of people that quite often are not measured or rewarded on accuracy of cash flow forecasts, as we mentioned earlier on.
Okay, well, actually, what you've just said, I know that we have waiting in the wings, but we're not ready for them yet. We have waiting in the wings, the responses to polling question 3. But before we go on to that, I would just like to pick up one of the questions that's been sent in to us, relates just to what we've been talking about. Some of our businesses are very good and enthusiastic about cash forecasting, but for some, a cash forecast is put together quickly on an indirect basis. Where a central treasury just provides finance on demand, it can be really difficult to engage the businesses with the importance of forecasting in the way they would be engaged if they were standalone. How do we address this? How do you recommend we address this? I think from my own experience, the first thing you need is the level of commitment that Erwin has described. You need to know that at least your CFO is right behind the idea of cash forecasting, and you can actually use that to communicate back to individual units the importance of rendering good forecasts. And another very good way of following up on the quality of their forecast is to do the variance analysis, identify the differences, and feed them back to them, either directly individually or in a group, so that they will get some feeling that the quality of what they're doing is not really good enough for the organisation. That feedback will highlight to them the paucity of the information they're giving you. So that's been my experience. Is there anything that you would like to add to that, Richard?
Yeah, I think you had that. You made a very good point. For instance, if a treasury just provides finance on demand internally, people aren't necessarily motivated to help predict when that demand is going to be there. And I think, as you know, sources of funding, if you just go to your bank today and ask for money, they're going to charge you a lot for it. But if you tell them in 3 months' time I'm going to need a loan for X, you're going to get a much better rate. And that's one way to motivate people to predict the flows more accurately and in a more timely manner.
Okay, thank you. I think that this is going to be a topic that comes back again. I'm just going to jump now to polling question number 3, because we have the results in now, and we can have a quick look at what came up there. Who's the winner? Well, what method do you use for forecasting? No surprises here, I think. 85% of you use a spreadsheet, and only 8% are using their integrated treasury management system. Now, that would really reflect my experience to date, but I'm a bit of an old campaigner, and I know that techniques and technologies and system support is developing much more rapidly than I am. With the tools that are available now, does that result surprise you, Owen, Zahid?
I would say in my case, it doesn't surprise me. I would say there's lots of work to be done in terms of education, but from my personal experience, what I've observed is quite often you do have cash management, treasury. They want to use the technology, but the underlying data, let's say, for example, sales terms within the system, it's not accurate. So your core data, your master data, there are some faults in that. And that just throws the entire process out.
Yep.
So it's not that the technology is not there, and sometimes not that the willingness is not there, but the process can be quite painful to get the right quality data, which is effectively what we saw in the earlier poll.
Okay, I understand. And Richard, there's quite a market out there for you from the looks of this.
Yeah, so to be honest, it's no surprise. Everybody loves Excel, right? We all like Excel, and even if quite a few organizations have advanced forecasting techniques that they do in a TMS, it wouldn't surprise me at all if the results of that ended up in a spreadsheet as well. So what we're aiming to do is provide the tools to gather and analyze the information, but also not restrict them from putting it in the format they're most comfortable with.
Okay, well, thank you very much. I'm going to move on quite quickly now, because we're gradually coming towards the end of our session. There have been quite a few questions in from the audience. One person has pointed out to us that, just an observation from experience, that the different cash forecasting methods that Owen described may be appropriate in different circumstances for different time periods. And I think that's certainly something that we have seen before. We have also had asked the question, do you need a system for this? And I think the answer to that question is probably in the presentations. Certainly it's clear that people can get by with spreadsheets, but if you want a better quality integrated cash forecasting process, you really do need system support. One more point here. Somebody says that the greatest challenge they've faced with cash flow forecasting is getting information from their subsidiaries, which are focused on reporting the past rather than predicting the future. How do you deal with that? And any offers from the floor on that one?
Yeah, again, I would say wherever you've got the buy-in from the top guys, you would find them falling in line, although sometimes you do have problems where the subsidiaries themselves are quite autonomous. So you may have to use other incentives or even penalties, which I've seen one company do, where you have large variances. Okay, well,
thank you very much. I'm going to move on towards wrapping up now. Somebody has asked the last question, in case there isn't a dedicated forecasting treasury function, to whom in finance would you delegate cash forecasting? I think the answer may be there, it's Treasury, and you may have to try and grab something up yourself, but certainly to try to persuade other people of the need for dedicated resources and system support, I think will be a very good way forward. So I'm going to call a halt there on the question and answers. Thank you very much indeed, Richard, Owen and Zahid, for your contribution. I think we've covered a very good, a lot of ground today. The key learning points that I think are worth taking away are that many of us face similar challenges. That's clear from the questions that are coming in. Identifying, analysing and understanding the drivers which influence your cash forecast is a very good way to ensure you focus on the right elements and don't waste time on immaterial components. You do need to keep going back and checking why actual varies from forecast so you can improve your methodology and your forecast. And if you can invest in building an integrated forecasting system of the sort we've described today, you can remove a lot of time-consuming elements and inconsistencies from your forecasts. Don't, however, forget the importance of the human element in making it all work, in feeding the right data into your systems and making sure that people cooperate and participate in the process. I'd like to end by saying thank you to our sponsor, again, OpenLink, to our presenters, Owen, Zahid and Richard, to the Question Meister, who was Michelle Price, to Diana Gregory and Daniela dos Santos and Katie Gordon for organising today's events, and of course to you, our audience, for dialing in and for making this work today. If you need more information from the speakers about today's presentations, please feel free to contact them. And on that note, I'll say thank you very much for joining in and making today a success.